Chairman. Chat, please. Meeting is live.
Thank you very much. Good morning, everyone. Welcome to the Pensions Committee. My name is Ralph Sangster. I'm the chairman of the Pensions Committee, and just a little bit of standard business to conduct before we get into the meeting. I have an announcement to read out, and that is the COVID-19 attendance at this meeting. Due to the coronavirus pandemic, the Council will be holding this meeting electronically in accordance with the relevant regulations. Members of the public may also attend this meeting in an electronic capacity. There is a link on the Council's website for them to do so. Members of this meeting are asked to keep their microphones and cameras switched off until called to speak, and to switch their microphones and cameras off once they've finished speaking. To indicate a wish to speak, members should request to do so using the meeting chat function or putting up their hand as a matter of course. At the end of the debate on each item of business, there will be a vote. Members should vote using the members chat function by indicating for, against, or abstain. I will declare the result after each vote. Officers are in attendance but will keep their cameras and microphones switched off until called to speak. There may well be necessary, considering the length of our agenda this morning, to call a break in the middle, in which case I will do so and we'll reconvene at an appropriate time. I think most of our members are with us today, and I'm going to call each of them in turn to introduce themselves. Would they make sure that they turn their camera and microphone off once they've done so? May I ask Stephen Bolton if you would like to introduce himself first? Margaret, could you take your microphone and count that? Thank you very much. Stephen.
Hello, Stephen Bolton, obviously member of this committee, and I have the division for Hatfield Rural.
Thank you. Bob Deering.
Thank you, Chairman. I'm Bob Deering. I'm the member for St Andrews division in Hertford.
Stephen Drury. Stephen, are you with us? Elaine, can you confirm that Stephen's with us?
Yes, morning, Ralph. I am here.
Ah, struggling to put the microphone on, Miguel.
Yes, I was pressing the wrong microphone, actually.
Easy mistake. Just introduce yourself, please, Stephen.
Sorry?
Just introduce.
Yes, Councillor Drury. I represent Croxley Green, and I'm here at the meeting.
Thank you very much. Margaret Emerson Patterson.
Yes, can you hear me?
I can.
Yes, I'm County Councillor for Hatfield North, and I sit on the Pension Working Group, and I'm the Labour rep on the Pension Committee. Thank you,
Margaret. John Graham.
Good morning, Chairman. John Graham. I'm County Councillor for Potters Bar East. Thank you.
Thank you, John. Richard Smith.
Thank you, Chairman. Richard Smith, representing Welwyn Division.
Thank you, Richard. Adam Mitchell.
Hello, I'm Adam Mitchell, and I'm representing Broadwater and Stevenage, and I'm the Vice Chairman of this committee.
Thank you, Adam. Robin Parker.
Yeah, I'm Robin Parker. I'm Lib Dem County Councillor for the Chelsea Division of Stevenage. And if I just say to Elaine, if she's on the line, you resent me the Part 2 papers just now. It's the link to the Part 1 ones that I'd like you to resend, please. Thank you.
Seamus Quilty.
Thank you, Chairman. My name is Seamus Quilty. I'm the County Councillor for Bushy South Division.
Thank you, Seamus. That completes the members of the committee, but there are non-voting members who represent stakeholders outside of the council. And I'll just ask John Lloyd if he would like to make himself known. Joan Lloyd, sorry. Is Joan with us? Okay. Okay, they are not with us. Okay, all right. I'll move swiftly on to our agenda then. There are no substitutes that I'm aware of. Everyone is here. Apologies, none. So we'll start at part 1 of business, which is declaration of interests. Members should declare any declaration of interest at the beginning of the meeting or as and when the item comes up on the agenda. Minutes of the previous meeting. They were circulated. These are the part 1 minutes. Are there any issues which the members would like to draw to our attention on the minutes, please? That seems to be okay. I'm assuming, as there's no one wishing to challenge any of the minutes, that we'll take them as read and agree them. I think there are 1 or 2 items of action which I think would like to address before we move on. Patrick, the stage is yours.
Thank you, Chairman. With regard to the actions on 2.4, there is a paper on the agenda today, COVID-19 paper, but also I can confirm that the equity option strategy is now in place to address the falls in markets between 10 and 30%. Minute 8.4, that is covered later on the agenda. And 8.5, the rebalancing is in part 2 of the agenda today.
Okay, thank you, Patrick. Just on the equity protection, just a quick commentary on that, if you wouldn't mind. I know that we were concerned when we were in the midst of the pandemic that the market had retreated, and we might have missed the opportunity to have secured a good position on our market protection. But I now understand that we've been able to have a very high level and gives us the maximum protection that we were looking for.
Yes, so, Chairman, it's Patrick Towie here again, Head of Finance for Pensions and Treasury. I can confirm that the equity option strategy is now in place, and that will protect the fund from equity. We will incur losses on the first 10% of equity falls, but protected between 10 to 30%. That was confirmed by the equity option manager Insight on Friday. And the costs, the forecast costs for putting this in place, the actual costs are lower than the forecast costs. So it's a good outcome for the fund.
And the timing was fortuitous because the market had recovered at the point we did that. Is that not correct?
Yes, that's correct. We were a bit concerned back in February, March that we may be putting this protection in after the event, so to speak, after market falls, but the markets have appreciated since March, and the equity protection cover, we sort of benefited from that upswing in equity prices.
Okay, thanks very much. Any questions on that, by the way, by the members?
Yes.
Yes?
Yeah, I'm not quite sure how to...
Sorry, yeah, Robin.
Yeah, thank you, Chair. I'm not quite sure how to indicate electronically, so I stick my hand up. I just wanted to know what the actual cost is. Patrick said the cost is less than we anticipated. I can't remember what the anticipated cost was. And is there an electronic way of putting your hand up on this thing, and where do I find it?
There should be, and either put your request in the chat line, or if you highlight the 3 dots on your pop-up screen.
Yeah, I've got that, yeah.
There's sorry, next to that is the hand up function.
Yeah, not on mine, there isn't, but anyway.
Okay, what's your piece of hardware? Like an iPad, or is it an Android?
It's a laptop.
A laptop.
Yeah.
Where do you adjust your camera and your microphone?
Well, the microphone and the camera on and off are on a grey bar at the bottom of the picture.
And there should be a hands up function there as well.
There's a show participants.
Okay, I'm not sure. Perhaps Elaine could could help you out during the process. I think we need to move on a little bit. But
it used to work last time I was on Teams.
Yeah, if you put your request to talk in the chat line, then we'll pick it up, or just butt in if necessary.
Okay.
Okay.
Anyway, the answer to the question from Patrick is the cost.
Chairman, in response to Councillor Parker's question, I can confirm that the forecast costs were initially at 20 basis points and the actual cost came in at 13 basis points of the cover that we put in place.
Right, thank you.
Reasonable discount.
Yes.
Okay, we're moving on now to the agenda. Now, this is quite a long agenda, so I'd appreciate if members could be concise in their questioning, and if someone else has asked a similar question, to dissent from asking us a similar question again. We can we're trying to get through the agenda fairly promptly, given the number of items which are on it. So our first item is item 2, which is the pensions fund draft accounts. And Phil, I think this is your subject matter.
Thank you, Chair. So the purpose of this report is to provide the Pensions Committee with the unaudited annual report and statement of accounts for 2019-20, which can be found in Appendix A. So the main summary points are as followed. As the pension fund audit has not completed at this point, there is no audit results report to bring to committee. We are hopeful that the accounts will be concluded by the end of September, and the results will be brought to the next committee meeting once they've been signed off by audit committee on the 15th of October. Due to COVID-19, the deadline for sign-off has been moved to the 30th of November, so we are within the deadline for completion. However, we are conscious of the impact this is having on district and borough councils, in addition to the county council's own accounts. The overall fund value fell by 29.1 million from the prior year, mainly due to the impact from COVID-19. So the overall investment return for the year was negative 1.5%, which was in excess of the global benchmark, which was negative 3.9%. Also, during the external audit review of the annual report and accounts, one spelling mistake was discovered and amended. Although the audit has not concluded, pension fund officers are aware of 2 items which are presented in the audit report. I will cover these items in a short time. Section 4 goes into the statement of accounts, a few of the main points. So item 4.7 discusses the increase in management expense. Whilst this is mainly due to an increase in investment manager fee, it also includes the increased costs from Hymans and LPP associated with the triennial valuation. 4.9 explains the change in value investments between 1819 and 1920. From the initial good returns from quarter 1 to 3, quarter 4 2019 resulted in a negative 8.1 net return, mainly due from COVID-19, which showed an overall loss of 100.2 million in 1920. 4.11 discusses the transfer of the RLAM mandate to the access pool. Due to the asset category being the same as post-transfer as prior, readers of the accounts will not see the transfer identified in the transfer to other categories in note 6.7 of the accounts. Section 5 regards the annual report, which outlines more information about the management of the fund. Section 6 goes into the 2 items which are identified in the audit report. The first item is regarding note 1, contributions. Just to give committee a guide around this. So when the fund officers completed the analytical review, we noticed there was a large increase in the contribution codes. After further investigation, it was discovered that the employer contribution and employee contributions were posted the incorrect way around for 2 employers. This was quickly fixed and disclosed to audit. However, as this was after the submission of the draft accounts, it would have to be disclosed. The second item regards level 3 assets. So due to the nature of private equity valuations, in which assets are valued 1 quarter behind, the year-end results of private equity do not show the impact of the market conditions from COVID-19. Furthermore, due to COVID-19, there have been delays in receiving audited financial statements from some of our level 3 investment managers, which EY rely on for gaining insurance on asset valuations. The outcome of level 3 testing is currently unknown. If the difference is material, it would require restating the asset valuations. However, if immaterial, it would only require a note in the results report. The Pensions Committee is asked to note and comment on the unaudited annual reports and the statement of accounts for 1920.
Thank you, Phil. We do have the auditors with us. Patrick, is it appropriate at this moment in time that they come forward and make their report, or do we have them after the comments?
No, I believe the auditors are with us, Chairman, and I would invite them to comment on where they are with the production of the draft with regards to the audit report.
Okay, thank you. I know Sharish Patel and Nick Hoare are with us. Which of you is going to Sharish? It looks like you're up.
Morning, Chairman. Yeah. I'll enter the breach, Chairman. So thank you for the opportunity to give you a verbal update in terms of where we are with the audit. I think, as Philip has already alluded to, and as outlined in the report that you've got in front of you, the impact of COVID-19 has been to hinder the audit progress. I audit 6 other local government pension schemes, and we're having similar issues. And I would say that there's twofold impact in terms of COVID. One is just the general execution of an audit. Things are taking longer in terms of how we engage with officers to obtain information or resolve queries, and that has just slowed things up. But secondly, as Philip has alluded to, the bigger issue for pension fund audits has been the getting assurance over the valuation of level 3 investments, particularly around private equities. Combination of the volatility in the market as at the 31st of March, as you'd be aware of, and then as Philip alluded to, the timing of receiving audited financial statements for some of those investments, which clearly provide us with solid assurance around the valuation. So those two issues combined, as I said, led to our progress not being as far as we would ideally like it to be. Having said that, as Philip said, we are working to get everything complete by the end of September. And in respect to the private equity work that Philip alluded to, that is almost complete. So we'll be able to discuss with officers this week where that has landed in terms of any differences that we identified in terms of the valuations. I suppose the only one other area of focus has been around post-balance sheet events. And again, that's more about asking officers to consider, well, what has been the movement in terms of asset values since the year end? Does that require any kind of disclosure in the accounts? We wouldn't be expecting any kind of adjustment, obviously, but more of a disclosure in the accounts. So that's where we are, Chair. Like I say, we're aiming to complete by the end of September. There might be some changes in respect of the asset values that we've referred to. But other than that, we're happy to take any questions, Chair.
Thank you very much. Adam, I see your hand is up.
Thank you. I'll just would ask the auditors if they're sort of confident that they've got the level of resource needed, so that, for example, we're not in this same situation next year, and that they're confident that they're happy with the sort of new ways of working post COVID, so that we're not in this situation again next year where we're having to delay the audit.
I should say, I mean, it's not about a delay in the audit because of our resources. It's because of the impact of how we work with officers in terms of obtaining information and resolving queries. Clearly, we've learned a lot this year, so of officers, and we will take that learning into future years. If, as we all suspect, this will become the norm in terms of how we operate the audit, although hopefully we'll be able to actually meet face to face, which I think would speed the process up. So I'm confident we've got the resources to complete the audit by the end of September, and I'll be confident that we'll have sufficient audit resource in place next year to ensure we meet whatever deadlines are set by the government in respect of audit reporting.
Thank you.
Margaret, you have your hand up.
Yes. I'm not sure if now's the time to raise this, but it was really to do with liabilities and how much we have forecast the next 5 years to do with pensions payable with the increases in salaries that our Chancellor has agreed to. And I haven't seen that anywhere sort of properly forecast yet.
I think, Margaret, that might be a valuation issue. Patrick, do you have a comment on that?
Yes, Chairman, I would agree that is a valuation issue, and fortunately we do have our actuary on the at the meeting today, and we can ask that question later in the agenda when the actuary is presenting. I don't think, with respect to Councillor, this is not for discussion on this paper.
Margaret, is that acceptable to you?
Okay, yeah, I can hear. I wasn't quite sure if it was part of today's discussion.
Okay, if you could bring it up when the the actuaries are presenting their points, that would be better on that occasion.
Yeah.
John, your question. Robin, I will come back in a second.
Okay, Chairman, thank you. It's really to the auditors. The 31st of March was probably at the peak of some of the volatility in the markets and the uncertainty over COVID. Since then, we've seen an increase in the markets. You're probably in the unfortunate position of having to form an opinion at probably the worst moment in the pandemic. How do you reflect in the accounts the events that have taken place, some of which will probably show a positive reflection on events or on the accounts? Thank you.
That's a good question, Councillor. So that really forms the basis of the post-balance sheet events consideration that we would expect management to undertake. We are aware, and we've seen it elsewhere, that things have bounced back quite considerably, but we don't consider that to be an adjusting event because obviously COVID happened before the year end. So it's more about the disclosure around the value of those assets. And so I've got other pension funds which have in effect stated in that post balance sheet events note what the current value is of those assets, just to reflect that kind of movement since the year end. But we're not expecting that to be an adjustment of any kind. It's more about disclosure. So we're not really giving any kind of opinion on the current valuation of those assets, but more making sure that the accounts reflect the current situation as a disclosure as opposed to an accounting adjustment.
Okay, thank you.
Thank you. Adam, do you have another question? Your hand is up.
Yes, please. I'd like to ask about the error that was found. It's in 6.1.1 in the report, and my question would be why was that error in the contributions not picked up by the auditors? Why did it need to be picked up by the council officers? Why hadn't it already been picked up by auditors?
I think officers can correct me if I'm wrong, but that they picked that up as part of their own review of the accounts before we started the audit. Is that right, Patrick?
Yes, that's correct, Suresh. I was going to let Matt comment, my colleague Matt comments on that, but yes, we picked that up first and then disclosed it to the auditors.
Okay, Robin.
Sorry, I was just trying to understand. So that error was picked up by officers before the accounts were handed over to the auditors. Am I right in thinking? Is that right?
Before we started the audit, but I think the accounts have been published by then.
Well, the draft of the draft.
Yeah,
account.
the draft. Yes.
Okay, thank you.
Robin.
Yeah, my question is to do with the officers' report, paragraph 2.1, where halfway down that paragraph it says, we'll bring the results of the audit back to the Pensions Committee at the next meeting on the 29th of October, which with the board's agreement will become partially formal. And I just want to query why with the board's agreement does that meeting become partially formal? Isn't it the committee's agreement to become partially formal, or does the board have to be consulted over making a committee meeting formal? I don't understand that. Why the board have to be agreeing to make the meeting formal?
Good question, Robin. I've got a note on my chat line here that we were today being required to approve that the part of the 29th meeting would become formal, but perhaps Patrick could explain the meaning of the note that's in the account.
It should be, it will come back to the committee. The board will see the draft accounts as well, and they'll be in a similar position to this committee in that they won't have a draft, they won't have an audit report to accompany those accounts. So the board will have a view of the accounts, but it is the committee who will decide whether that informal meeting on the 29th of October can have a formal set part to it to see the final audit report after it goes to audit committee earlier in October.
Right. Yeah, thank you. Yeah.
While we're on that point, I'm advised here that we need to agree that amongst ourselves to ensure that the 29th meeting is partially formal. So can I ask if anybody is opposed to that, please put their concerns in the chat line. Otherwise, I will assume that everyone is in agreement that we should have a part formal meeting on the 29th to approve the accounts. Give a few seconds for anyone to type in. I can't see anybody typing in, so I'm assuming that that's okay. Elaine, is that sufficient?
Meanwhile, thanks to Patrick for explaining that bit. I thought it was an error, and it clearly is. Thank you.
Elaine, are you happy with we have approval for that? Okay, that's good. All right. Any other questions to the accounts team and or the auditors, please? Patrick, you've got your hand up.
Just one point, Chairman. I am aware that a number of committee members couldn't attend the session on Friday when we did a training session with committee members to go through the accounts. I believe the presentation has been shared with the whole committee now. If those members who couldn't attend on Friday would like the session to be rerun, we will do that for you. So if you could let me know by email, and we'll set up the session for those members who couldn't attend.
Robin, if you could take your video offline, thanks very much. And I can't see anybody else indicating that they would like to ask a question. I'm just looking to see what the recommendation is. I don't see a recommendation, which I assume that means that we were just to note the reports. So I'm assuming that everyone has had an opportunity to note and or comment on the report. So we'll move on to item 3, which was the Hertfordshire County Council's Pension Fund Investment in Fossil Fuels report, which was presented to the RP panel on the 4th of September. This was in response to the motion that was passed down from full council in previous months, and in response to a petition that was put forward by interested parties. So, Patrick, I think you're presenting this.
Yes, thank you, Chairman. This is a report, as the Chairman has alluded to, that went to RP panel earlier this month. It is a response to the motion that was brought to County Council back in February, on the 25th of February. The reason I've asked this paper to go on the agenda is to share with the wider committee the content of the report that went to that Cabinet panel, and to basically inform the committee that the recommendations contained within that report were unanimously agreed by that panel at that meeting on the, let me just check the date, it was 3rd
of September.
3rd of September, sorry. So the report basically sets out what the Pensions Committee had and the working group has been doing with regard to addressing ESG policy, responsible investment, and members will be aware that you've done quite a substantial piece of work. There are reports on this agenda later on that cover some of the items that you've worked on during the past couple of months during lockdown, pandemic, working remotely. So the working group has been very active in working towards developing the Responsible Investment Action Plan. We've shared with you previously the results of the carbon footprint. You'll also have seen that our fossil fuel holdings have fallen since the value that was reported in the motion back in December. They've basically halved. We'll also see that in the report we set out the fiduciary responsibility of this committee, which the chairman was quite clear to explain to the members of the panel at that meeting, and that is that our responsibility, or your responsibility as members and oversight of the fund, is to ensure that there are sufficient assets to pay the liabilities that we have to pay in the future to current pensioners and future pensioners, and that the investment strategy should also take into consideration non-financial considerations, but the primary role is to ensure those pensions are paid. So I wasn't going to comment too much on this report because it has already gone to a panel. It's more for information purposes, but I'm quite happy to take questions from members of the committee.
Thanks, Patrick. Richard, you have your camera switched on, so we're. Did you want a question? No. If you take off your camera at the same time, Robin, you're up.
Yes, thank you, Chair. Thank you, Patrick, for this report and for what you said a moment ago. I think we just need to reiterate, don't we, that the Pensions Committee and the Investment Subcommittee cannot be told what to do by full council or indeed anybody else. Our responsibility is to make sure there are funds there to pay the pensions when they become due. And we also want to make it clear, and Patrick can correct me if I'm wrong, that the reduction in our percentage of the portfolio, which is fossil fuel based, was not in response to what full council passed. It was for commercial reasons, because Baillie Gifford saw that it was the commercially correct thing to do. And I think if that's correct, and I believe it is, Patrick, I'd like you to just confirm that it was the reduction is not really to do with the motion that was passed at full council. And I think we just need to make it clear that there is actually no direct link between us investing in fossil fuels and global warming. When you buy shares, you do not give money to the company that you're buying the shares from. There is, of course, a moral argument, and there's the stranded assets argument, all of which we can be considering and have considered, and will consider further, I'm sure, under our RI policy. But I just wanted to make those 3 points, and I'd be interested in Patrick's comment on whether the motion at full council had any effect or not.
Thank you, Chairman. Thank you, Councillor Parker, for your questions. To make it clear, and I did at that panel meeting 2 weeks ago, that the decision to disinvest from Shell by Baillie Gifford was not made because of the council motion. It was an investment manager decision, and it was based on the facts that they didn't believe the thesis for continuing to hold the investment in Shell stacked up. There were financial reasons behind that disinvestment, and that was because Shell decided not to pay a dividend. But Baillie Gifford were quite clear as well in that they didn't feel that holding Shell no longer provided the value that it did in the past. I'd also say that investments in fossil fuel companies, and Peter, again, our consultant from Mercer, might confirm this, the value of those companies has fallen during the pandemic, and would express a lower percentage of the overall fund. The economy slowed down during the period, so asset values in those companies, there was a bit of a sell-off in those oil and gas companies, so the values would have fallen, hence why they're shown as a lower percentage of the fund. But to be clear to Councillor Parker's first question, the motion did not influence the fund's decision or investment manager's decision to disinvest from fossil fuel companies. Allianz, our other manager, global equity manager, also made a decision to sell a holding in a fossil fuel company around the same time as well.
Robin, you wanted to come back?
Yes, thank you, Chair. Just thank you for that explanation, Patrick, or clarification or confirmation rather, Patrick. But a moment ago, Patrick, you said that Baillie Gifford decided to disinvest from Shell because Shell had decided not to pay a dividend. I believe they did pay a dividend, but I believe that dividend was cut from 47 cents a share to 16. So basically a quarter or whatever it is, a big reduction. I think that was the reason. Not that there's no dividend, just Shell have cut their dividend from 47 to 16, I believe.
Right, thank you, Councillor Parker, for the correction there. It was a combination of factors. The dividend, financial income was one of the factors, but overall it was Baillie Gifford did not believe that there was a strong case for continuing to hold Shell within the portfolio. That's not to say that view may change in the future if Shell was to develop strategies to transitioning to a green economy, which no doubt they are. That Baillie Gifford may revisit that company and look at it differently and decide to buy shares in that company again. That's why we give discretion to our investment managers, because we believe they have the knowledge and understanding to make those decisions on behalf of this fund and the committee.
Yes, thank you, Patrick. Very clear. Thank you.
Thank you both. I'd just like to say a couple of points, a couple of words on points relevant to this. There was a recent House of Lords, Supreme Court, used to be the House of Lords, Supreme Court decision on the responsibilities of pension fund committees, which stated that the principal position for committees is the responsibility to ensure that members of the pension fund have the appropriate funds available to pay their, or the fund has appropriate amounts of money available to pay future commitments to those individuals. It did go on to say that we could take into account other issues, but the principle, and those could be in respect of climate change or other social issues. But our primary function was to ensure that there was funds available to pay the future commitments of the fund. I think the argument from those who would wish to see a focus on the reduction in fossil fuels and other issues is that the investment capacity of the fund in terms of its future returns might be diminished as a consequence of those companies who are high carbon emitters being less valuable in the future. And I suspect that that's probably true, but I think we must take a view that that in the medium to short term there are principal issues in relation to returns. But we do keep those other things in mind, and that's the focus of our new arrangements in relation to our ethical investment policies, which perhaps, Patrick, you might just mention the fact that those are in process and will be drawn to a conclusion, and we will have a full set of ethical investment policies for the future.
Yeah, so with regard to the development of the responsible investment policy towards ESG, we've done quite a substantial piece of work with the working group. There is still more work to do. I'm working with our consultants, Mercer, to develop an action plan. There is a stewardship report later on, part 1 papers, which talks about some of the things that we can consider with regard to policy changes and signing up to the stewardship code at some point next year. There is still a substantial piece of work that we need to do in developing this policy, and also with working with our fellow funds in the Access Pool, who are doing the same thing at the moment, developing a pool policy for responsible investment. We need to make sure that our views are being fed into the development of that policy at the Access Pool level.
And also, I think that it's worth drawing people's attention to the fact that we are not just looking at those companies that are high fossil fuel users or developers, bringing the oil out of the ground, but we've developed a process that we're looking at the whole of our portfolio in terms of its carbon footprint. and we're measuring that against our decision-making process to ensure that we understand what that decision-making process is doing to our carbon footprint. Patrick, I don't know whether you want to just confirm that that's the case.
Yes, that's the case. The carbon footprint results, which are contained in this report and also in the stewardship report as well, we will revisit and take a carbon footprint every 12 months or when there is a significant change in fund manager. And so we have a baseline position now, and so we can monitor that change as the strategy evolves in the future. One point I would like to make, which I made at the panel, is we do have investments in wind farms, which is not captured in this report. Our infrastructure manager, Macquarie, has invested about £17 million worth of our commitment of 75 million in wind farm investments in the Irish Sea and the North Sea. So they're offshore wind farms. So that's an intent that we are looking at alternatives to fossil fuels, and that our manager Macquarie is looking for those opportunities.
Thank you, Patrick. I think I don't see anyone else looking to make a comment or ask a question. So we're asked under the recommendations that the Pension Committee notes the content of the attached report, which I think we've done. And we're going to move on now to item 4, which is the Risk and Performance Q1 report, and Anne is the officer presenting it.
Yes, thank you, Chair. This is the Risk and Performance Report for April to June 2020. Alongside the fund valuation, fund officers had updated the risk register in Section 4, which was reviewed by the Council's corporate risk officers, the fund's actuary, and the fund's investment consultants. This will be presented in a separate paper. In Section 5, we have analysed the scheme employers by scheme categories. Red risk-rated employers decreased by 3 in the quarter, with the breakdown of their ongoing deficit position detailed in paragraph 5.6. The number of employers being monitored under each risk category is outlined in Appendix B. The admission agreement policy was approved by committee in July last year, and we've had very positive results. Since implementing the policy, interaction with employers has improved significantly, with comments and queries being received promptly. The policy's success has been evidenced by the number of outstanding admission agreements halving from 30 to 15 in a year. The past few months of lockdown has caused a delay in receiving documents from 7 employers. Therefore, we expect to receive a continued decrease in outstanding admission agreements next quarter. The emergence of COVID-19 tested the fund's risks associated with employers defaulting on their obligations to the pension fund, which we have detailed further in the risk register paper. We're pleased to note that control mechanisms have been effective, and the fund has had to report a breach to the pensions regulator for consistent non-payment of contributions. To tighten our controls further, we've developed a COVID-19 fund policy with the actuary, which will also be presented in another paper. The performance monitor highlighted in Section 6 highlights the completion of the interim audit in March and the status of the current year-end audit, with the expected completion date before the deadline in November. Details of complaints and IDRPs are outlined in Appendix A, and the LPP's performance against their SLAs remains elevated above their target of 95%. Thank you, and I welcome your questions.
Thank you, Anne. Adam, you have a question.
Yeah, it's just a very picky point. On table 5.3, could we have the red and the green reversed?
Yes, thank you.
Thank you.
Yes, well done, Adam. I was going to bring that up myself. Conventionally, you usually put the red on the danger area, whereas it's got the green. Clearly, it was either someone who was colourblind or a lapse in concentration when they. Can
I just make another point though from reading the point? The thing about the admission agreements, I think that's really good news, and it seems that being a bit more proactive, sort of in previous months, is actually starting to pay off now, and that's really good to see. So thanks for that.
Thank you.
Yes, I think Adam, you're right. We spent a lot of time about a year or so back looking at this subject. The concerns that these issues had been outstanding for sometimes up to 2 years was concerning, and the policy that we put into position seems to have triggered a significant change in attitude by those who were formerly just letting it slide. There is one other issue that I think I'd like to bring up in a moment, but I won't do so at this moment in time because I can see Margaret would like to make a comment, and it may well be about that topic. Margaret.
Thank you, Chair. Yes, I just want to thank you for putting in. It was very much proactive work for the admissions agreement, but I just would like to say I don't think we should be complacent. There are still 15 employers who haven't quite complied yet, so I think we just need to monitor them and be aware that sometimes we do need to be proactive to protect our fund holders, our pensioners rather. Sorry, pensioners. But I'm really glad that we did that action, though. It was something I felt quite strongly about, if you remember.
Absolutely. Adam, I see your hand is still up. Is that a legacy?
No, I'm all done. Thank you.
Okay, thanks. There is an area I spoke to Patrick about at the pre-briefing, and that was in relation to the situation where employers have a legacy deficit in relation to their contributions, and where they are currently not a contributor to the fund. In other words, they've lost all of their employees who are making contributions, but they still remain in deficit in relation to the overall position that the actuaries have assessed that they should be, or the amount that they should be paying. Patrick, could you just give us a little bit of a background on that and where we are looking at that as an issue?
Okay, so some of these employers, as the chairman has correctly pointed out, are legacy employers that came into the fund quite some time ago. And when I mean some time ago, we're talking about 30 odd years ago, when the means to gain admission to the fund were not as stringent as they are now. And the type of bodies that entered the fund during that time were like community, they call them community admission bodies, such as Citizens Advice Bureau, any sort of a charitable body that could be providing services to the people of Hertfordshire. And what's happened over time is that these employers would have come into the fund with 100% assets and 100% liabilities, but over time their income streams have fallen in that grants that were probably given to them by the county council has fallen, and streams of income that they have got from donations has fallen. So they are now at a position where the liabilities are growing, but the income coming in to offset those liabilities in the form of contributions is not keeping up with the liabilities, and the deficit has grown. There are also bodies that are in the fund that no longer have active members, so the only contributions are coming in from employers who may no longer who may not have the income flows again to pay those contributions. As a percentage of the overall fund, it is quite small, and what we've been discussing with the actuary for some time about setting up a separate pool of these employer bodies so that we can sort of over time run down, crystallise these liabilities, because at the moment the liabilities are continuing to outpace the assets, and if we don't crystallise it and put it into some form of pool and run them off, then the liabilities will continue to grow with respect to these employers.
I'm assuming that's going to be something that's going on to the working group's agenda for consideration.
That is something we could bring through the working group. We would want to develop this with, and obviously have conversations with our actuary first of all to get a sense of what sort of model we can propose and how it would work, because it's key that we want to protect other employers within the fund from subsuming these liabilities in the event of a default of one of those employers.
Thank you. John Graham, your question.
Chairman, it just built on that point. I was very struck. I think it's on page 14 of the report about this thing to do with active member age profile. Just building on what Patrick said, where you lose your employees. If you get to the stage where your last active member retires, does that then crystallise a liability in the employer? And do we then find? I'm looking at the risk 11 that we. Is this where we're getting some of those employers that you've just been talking about, where they move into a legacy category rather than an active category? I know there's only two, but it's just interesting to understand if that's a point where a potential liability crystallises.
So, Councillor Graham, thank you for the question. That is the case when a employer who's been admitted to the fund, and it could be because of they've been awarded a contract by a district or county council. When they get to the end of that contract, the position is crystallised, i.e. that there is liabilities. The actuary will do a calculation and will then tell us whether there is a surplus or a deficit on that crystallisation event. And then we'll have a conversation with that employer about their ability to pay it if there's a deficit. There is also instances where we have surpluses, and there is a further agenda item on this today's agenda talking about how we deal with exit credits. But with regard to deficits, again, it's about the ability of that employer to pay the deficit, and sometimes we do agree a repayment plan over a period of time. But ideally, when that event crystallises, you should get the payments of the full deficit at within a couple of months of that deficit being crystallised.
Patrick, is it not the case that a future deficit might occur depending on the value of the pension fund overall, and that employer would still be liable to meet that deficit?
The employer's that deficit position that crystallises for that employer is and should be met by that employer. The only time where we have had in the past, and there's one I can think of where a particular employer went into administration, and we were a creditor. We were told that there was no assets to pay the pension liability. And so we then went to the outsourcing authority, and I won't name the authority, and said, well, you outsource this contract, the liability, we cannot let that liability fall across all the other employers within the fund. So the assets and liabilities will need to fall back to you as the outsourcing body. And that's what happened in that event. And I think the sum was about £4 million at the time.
Okay, thank you very much. Well, I'm sure there'll be some nuanced detail of that when it comes through the working group and subsequently on to the committee for consideration. Any other questions in relation to the Q1 report before we move on to the risk register? Okay, Anne, is it you're presenting this as well?
Yes, thank you, Chair. The Risk Register report details the changes that we've made to the Pension Fund Risk Register in order to address the emerging risks in the LGPS. Over the past year, there has been increased activity in the LGPS as a result of consultations on proposed regulations, continued conversation about ESG and responsible investment, and an increased awareness of cybersecurity and fraud. As a result, the pension fund officers performed a thorough review of the risk register to ensure that it was robust and addresses the associated risks in these areas. Following our amendments, the register was addressed and reviewed by the Council's corporate risk officers, the fund actuary, and the fund's investment consultants. The fund therefore mirrored the Council's risk scoring approach, and the officers scored these risks individually. Current risk scores were reviewed further in detail by the actuary and investment consultants and are subject to review in the next quarter. Details of the fund's approach to risk and risk scoring will be outlined in the risk management policy, which will be presented to this committee at a later date. The emergence of COVID-19 occurred after the fund's review of the risk register. However, we're pleased to note that the control mechanisms we have in place at the moment have been effective. We have developed a COVID-19 policy, which will be presented in another paper, to heighten the current mechanisms we have in place. Thank you, and I welcome your questions.
Thank you, Anne. Yeah, this is a re-presentation of information that we used to receive, but in a totally new format. And I think the graphics and the arrangements are in somewhat respecting the way in which the access pool presents its risk register. And Patrick, perhaps you could just give us an indication of where the new arrangements are hoped to inform us better.
Yes, thank you, Chairman. I was, and I had a discussion with my officers about the risk register, and in particular that it was not, I don't want to use this word, but buried in the previous report. So it wasn't as transparent as it should be. I think the risks that the fund are exposed to should and warrant a separate report, and this is the purpose of the development of this report. It is based on it is similar to how risk is reported at an access level, but as my colleague Anne has mentioned, we have taken into consideration a review by our corporate risk register team, and also we've taken a lot of input and worked with our consultants, our actuary and our investment consultant, to comment on the risks that we should be capturing in the risk register. You will see in the report Appendix A the background and the sort of risks that we're capturing, and then how we score the risks, and that is based on the corporate risk register. And then there is the current risk detail on pages 2 and 3, and we capture them under 5 overarching risks. And you can see there, risk A, the pension fund investment strategy does not deliver the long-term projected investment returns. And then the sub-risks that fall underneath that. And then on page 5 of this appendix, you'll see key extracts from the pension fund risk register. And this will provide each quarter, what we will do is add additional narrative where a risk has changed. And so if, for example, risk 1 goes from amber to green, members of this committee would want to understand why has it gone from amber to green, or vice versa, amber to red, and we will put some narrative in that particular risk to explain why, and also it will be reflected in the scoring of the overarching risk. So essentially, why my officers and I have taken this and put it as a separate report is to give it more transparency, so that members can clearly see how we are managing risk, the mitigations we're putting in place. And one of those is the equity option strategy, and how we report on the change in a particular risk. So we've produced this report for members to consider and comment on if they like the structure of it. Is there something else they would like? And so it's more for you to comment on, and if you like the way this report has been presented, we intend to present it in this form going forward on a quarterly basis.
Thank you, Patrick. I note before anybody gets to the point of putting their hand up, and I notice there aren't any at the moment, but clearly having scanned through the report, at the moment the risks are either green or amber. We don't have any red risks at the moment, which is a good thing. I certainly think the opportunity for members to look at the report and quickly identify issues that are of particular concern, for instance, a risk turning from green to red to amber, or from amber to red, or even from green to red in difficult circumstances, is a good thing. We can then focus on those issues which are of importance and need attention. So yeah, from my perspective, it's a much better visual key to noting the changes, and I'll invite anybody from the rest of the panel who might want to make a comment or two. Well, here we are, Stephen Bolton.
Thank you, Chairman. I just wonder how the risk of cybercrime is assessed. I assume we don't walk around with any sort of intelligence on this that we receive, but it is a general sort of assessment that might possibly happen.
Okay. I can hear bells in the background. I'm not sure if it's.
Could you just make sure your microphones are all off?
Okay. Hopefully you can hear. Hopefully you can hear me, Councillor Bolton.
Yeah.
With regard to cybercrime risk, we will talk to our contractors such as LPP and ascertain what sort of security measures they have in place for data management, and get relevant reports from them on that. Also, with regard to the holding of our assets by our custodian, we'll also seek reassurance from them on how they are managing cyber risk. I agree, it is very difficult, but the only way you can, as a corporate entity, you would talk to your suppliers and make sure that how they manage data, they've got the correct data management systems in place. And firewall systems as well. So our custodian will have invested hundreds of millions of pounds in protecting their systems. In a similar way, LPP, our administrator, will have put in similar controls around firewalls for protecting membership data, and how that data is transferred between the LPP as the administrator and the actuary. And the actuary will also have firewalls for the receipt of that data and security and how that's transferred. So we will talk to our suppliers and get and ascertain what systems they have in place.
Yeah, okay, thank you. And has there ever been any?
You do get occasionally a data breach in that, and I'll give an example where a member's annual benefit statement may have been sent to another member by mistake, and what would happen there is LPP would then contact that member and put in place, they will sign them up to some sort of data protection system which protects their data. I can't go into too much detail of it because it's an LPP question to answer, but they would provide that member who's been impacted by this with some form of insurance that if they suffered losses as a result of their data being compromised, then they would be protected.
Yeah. Okay. Thank you.
Hill, could you turn off your camera, please? You're constantly on screen. Thank you very much. Okay, I think John Graham has a question.
Chairman, you're asking for feedback on the risk register. I think it's great. I think being able to take the risks and putting them all onto one page. So I think the real challenge of risk registers is not building them and understanding the risk, but actually putting them in such a way that people can read them and go down to those risks they're interested in. So certainly I welcome the representation. I've just got one question on risk 8, which is the unpaid employer costs, and we may be coming on to this later. Are we seeing any sign of the strength of our other employees in the scheme deteriorating? I see it's still at amber, so I hope that we're still okay. But are there any indications of problems arising?
Anne, do you have an answer to that?
Yes, so the employers that fit in this category, as we discussed previously, are also those employers that have ceased participation in the fund but have an outstanding deficit to pay. So we would deem these as unpaid employer costs. And something that we do is we monitor this in a risk monitor. We've been contacting these employers to try and allow them to enter into a legal repayment plan to enable them to stick to a repayment plan and pay off the fund. Now, this is at amber because we do have employers that ceased quite a number of years ago, but they have been paying the fund on an annual basis towards their deficit. However, what we are trying to do, and in order to strengthen this control, is to enter into legal repayments and close the length of time it takes for them to repay.
Thank you, Anne. Patrick, you wanted to comment?
Yes, I'd just like to add, I think Councillor Graham's question may have also will probably referred to more what's happening now as a result of COVID-19 and employers' ability to pay their contributions, particularly as some of them may be financially constrained in that they're not, they weren't able to trade for a number of months. They had no income coming through. So yes, we had one approach from an employer who, and I won't name the employer, who due to the lockdown were unable to get any income streams in, and they approached the fund at the very early stages of lockdown to have a conversation with us about how we could defer their contributions until they were in a position that they could pay their contributions. And we had discussions about they had assets, physical assets in the way of property, and we had discussions about taking security charges over those assets, and discussed with our lawyers how we would put those in place. And thankfully, we are now, that employer subsequently came back to us and said, no, they're okay. They will be in a position to pay those contributions back to the ones that they couldn't pay earlier in the financial year. It's an example of an employer that recognises an unfolding situation and came to the fund at an early stage. And so we were quite happy to work with that employer, engage with them, understand their circumstances. And then you'll see the next paper on the agenda follows on from this and your question in particular, how we could develop a policy with our actuary to address employers that are struggling to pay contributions. The fund cash flows, that we are monitoring those cash flows, and to be honest, we haven't really seen any impact of COVID-19 on the employer's ability to pay those contributions. I'm not aware whether our fund is unique in this and that other LGPS funds are in a similar position. But yeah, we haven't really been impacted by this. But we had one example of one employer who came to us, and we had that conversation with them, and have, as you'll see on the next agenda item, the development of a policy to address how we deal with employers who are struggling to pay contributions.
Thank you, Patrick. I don't see anybody else with their hand up for a question. So the recommendation is to ask the committee to note and comment on the content of the attached report, that is the risk register, which I think we've done. So thank you all. Thank you, Anne. And we'll move on to item 6, which is a new proposal on a contributions deferral policy. And Patrick is initially going to present this, and then I suspect it's going to move on to our actuaries.
Yes, thank you, Chairman. So I'll give you some salient points. As I referred to in addressing the question from Councillor Graham, the fund has been working with the actuary to develop a policy, a COVID-19 employer deferral of contributions policy, to address those areas where employers come to the fund where they are struggling to make their financial commitments to the fund. And we've developed this policy with the actuary. One thing that we need to be clear about is that the regulations only permit us to defer the non-payment of contributions for up to 12 months. All contributions must be paid within 12 months. The policy that you'll see in the appendix, in which the actuary will talk about, has been developed in order to ensure an equitable and transparent approach in managing employers. You'll see in the policy that there are a number of key fund and employer considerations that we've taken into account in reviewing this, and how we agree a deferment policy with agree a deferment plan with a particular employer. I was going to invite our actuary, Catherine McFadden, to expand on the policy and give you some more detail.
Catherine.
I think it's
actually Barry it's going to be me that's doing it. But,
apologies, Barry.
No, you're okay. It's okay. So yeah, I'm going to take this one. Just as an introduction, I'm Barry Dodds, one of the fund actuaries at Hyman's Robertson. You may have seen me before at a face-to-face committee meeting. But yes, slightly changed days, as you can probably tell by my background today. So yes, Patrick's kind of covered a good summary of the reason for putting this policy in place. Our paper, which is in the pack, starts on agenda pack page 177. The initial 4 pages are kind of our advice to the fund around the background to it, reasons for putting in place a policy, and some recommendations. And then the final page of the document is a draft policy itself, which is what's put forward for agreement today, which is on agenda page 181. So Patrick's covered some of the background there. In terms of the situation, obviously COVID-19 has had an impact on the fund at whole fund level, in terms of the what's already been discussed about the market movements kind of towards March time earlier in the year. But also you have to bear in mind that the fund has hundreds of employers operating within it. So each of these employers has obligations to pay contributions, which are looked at individually at valuation time and set at an individual level for each employer. So these employers vary. Obviously, there's the districts and other councils, but there's also academies, charities, leisure centres, and various contractors as well. So there's a vast array of different employers within the fund, and they will have been impacted in different ways by the impact of COVID-19. So one of the main reasons for putting in place a kind of policy to address any contribution deferral requests that come in is that obviously some of these employers, such as leisure centres, theatres, employers like that who are within the fund, are likely to be having some cash flow problems and may well come to the fund asking for a contribution deferral. As Patrick pointed out, under the regulations as they currently stand, a contribution deferral is a possibility within the scheme year. So, for instance, the scheme year goes from 1 April this year, goes from 1 April 2020 to 31st of March 2021. The rates and adjustment certificate, which is at the end of the valuation report, sets out what each employer is required to pay within that year. And contribution deferrals can only take place within that year to the point where anything due in that year still has to be paid by the end of the 31st of March 2021. So there is a kind of end point whereby anything due in that year has to be paid. So there is a certain period of time to consider. It's not just a kind of endless deferment. There is an amount that has to be paid within that scheme year according to the regulations. But it does allow, most employers pay on a monthly basis, so it does allow you to defer some of those monthly payments until later in the scheme year. So the key considerations at kind of fund level around issues that might arise if you do grant a deferral of contributions for an employer is cash flow. Obviously, you rely on money coming in to pay some of the benefits as time goes by. Each month there are benefits due to members. So depending on the size of the employer and their members, you have to consider, is this going to be an issue? It's not necessarily something that would mean you wouldn't grant the deferral. It just means you'd have other considerations in terms of having to maybe sell some assets. But you would imagine this is relatively unlikely and that there'd be a significantly large employer that would cause this kind of issue, but just to consider that anyway. Fund returns, obviously you allow for kind of contributions coming in over the period of the year in terms of what you expect fund returns to be. If contributions coming in are deferred to a point where they are invested at an inopportune moment, or indeed the other way around, and you actually get a kind of benefit from it, then there's just those considerations to take into account as well. And then the final point we've said there on page 178 in the middle section is about administrative complexity. Obviously, the more of these deferrals you put in place, the more administrative burden it is to keep track of. In terms of actually considering a contribution deferral request, some of the key considerations at employer level are there.
Robin, if you just turn off your mic and camera, please. Robin, if you just turn off your mic. Robin, if you just turn off your mic.
Yeah.
Robin, if you just turn off your mic. Yeah. Robin, could you turn off your mic and camera, please?
Okay.
I'm trying to do.
Okay, I'll give you a minute because it's a lot of feedback from you.
Okay, I think.
Okay, go ahead.
Right, excellent. So yeah, at employer level, when you're actually considering a request like this, a lot of the consideration is around the covenant and the solvency of that employer. Obviously, you don't want to necessarily put an employer into liquidation by saying no, but also you want to actually have a good chance of them paying the money that they're due to pay at the end of the deferral period. So there's a few things we put in there to consider in terms of information that you require from the employer about written assurances and so on that the other creditors are being treated the same, around written assurance that things like dividends aren't being paid at the same time, and actually just further background as to their plans for getting through this period of hardship, if you like. There's a couple of other things we've noted there around interest. It is possible to charge interest on a deferral period. Things around redundancy, and you have to consider strain costs that might apply if members are to be made redundant, and they take an immediate pension. Then there is a strain cost that would be payable by the employer. So there's these considerations in the background, and also guarantors. If there's a guarantor in the background for this employer, then their views on the matter will also should also be taken into account, given that obviously if something goes wrong, that employer becomes insolvent, then falls back on that guarantor to make any payment that's outstanding. We have noted, as an important point, about employee contributions. These must be paid. These cannot be deferred at all. These must be paid over in the usual course of events every month, as per usual. There's not a possibility to defer those. So the recommendations and what's kind of factored into the draft policy at the end is limiting the period of deferral to a maximum of 3 months at any point in time. It would be possible to extend that 3-month period following a review at the end of that, but actually not just having a kind of either a lengthy period or a kind of infinite period of deferral. Actually structuring it that way, where you have a short 3-month period. A lot of it is around evidence provision from the employer as well. You obviously want to get as much evidence from them as you can that they aren't able to pay and that they will be able to pay come the end of the deferral period. And also, as I mentioned earlier, discussions with the guarantor about their views and any kind of security that can be sought from that perspective, either from the employer or the guarantor. That kind of covers the background to it and the recommendations and essentially what's been put into the draft policy statement. And so we'll welcome any questions on the statement itself.
Okay, thank you, Barry. I think Adam has a question.
Thank you. This paper deals with deferrals due to COVID. And I was just wondering what the situation is for those who might want to defer for other reasons other than COVID. So is this something going forward that does it account for those people? I was just wondering.
It doesn't specifically address kind of non-COVID related deferral requests. Arguably, you could adapt it do that. There's no real reason in the regulations that says you can't kind of grant a deferral to someone who's saying it's not specifically COVID related. The same kind of backstop of the end of the scheme year would apply, and you would want to ask for the same kind of information, but you would want it to be some kind of short term. I mean, this is designed around a short term cash flow issue, which is why it's kind of very COVID specific, because you would expect some of these employers to be getting back up and running and more income in the future. So this policy is around a short term cash flow problem. So anything kind of longer term, wouldn't be appropriate to use this policy.
Okay, understood. Thank you.
Barry, it strikes me that if we are proposing this policy, and I think Adam's point here is a very good one. If we're going to do it, then why shouldn't we not do it for all situations that relate to short-term cash flow problems, rather than make it specifically about COVID? The fund would then have a policy which covered all circumstances in such a situation, as opposed to just having a COVID-related one, which might run out once COVID is sorted out. But it strikes me that it's something we might want to hold on to as an opportunity to deal with these issues in 2 years' time or 5 years' time. If someone came to us with a short-term cash flow problem, it gives us a framework to work around. So I would ask yourself and Patrick to perhaps look at it and consider it to be a wider remit policy rather than merely specifically COVID. I'm not going to ask you to answer that yet, because clearly that needs a little bit of a discussion between you and Patrick. But it strikes me that we shouldn't be limiting this to a COVID-related issue when it could well be something else that comes along that we would need to have a policy for. And I do agree that it's important for those of us, for the members of the employers, to know what the situation merits in terms of the fund's policy in relation to deferrals, whatever the situation might be. So perhaps you could take that up. Got a number of other questions, however. Margaret, you're on the top of my list.
Thank you, Chair. I was just a little concerned about timelines here, that I did hear you say that any deferral would have to be sorted by the 31st of March 2021. A lot of employers are actually in quite a fluid situation at the moment. I mean, we are hoping, but I don't think we can assume that COVID will be over by March 2021 in terms of the economic impact. In fact, many employers are, on tenterhooks at the moment, not knowing quite what's really going to happen, and whether we're on the edge of a second wave. And particularly, I was just going to say, and perhaps I should have, I'm not sure if this is an interest, but because I sit on a town council, I'm aware of how much we depend on sport and leisure for our income, which has been extremely clobbered by the first 5 months of COVID and having to shut down. And so come October, also when furlough has just changed now, but actually some employers really don't know whether they're really going to be able to be solvent by April 2021. So I wonder whether we should have had try to think of a more flexible policy, in that obviously we do want to reclaw as much as possible and make it possible for our employers to pay us, but whether just saying it's a 3-month flat repayment policy and not consider that March 2021 is a bit of an artificial deadline compared with what's really going on with COVID at the moment. Could you just give us your reply to that?
Yep. The March deadline is essentially a regulatory one. So as much as it's kind of artificial from a perspective of kind of COVID, it's very likely to continue the impacts of that beyond there. The March deadline is for regulatory purposes for contributions due up to that point. So any employer who doesn't pay their contributions that are due in that year technically it's a break in the regulations and you have to report it to the regulator. Now, the reason this policy is being put in place is for the kind of short-term employers where you think the situation might improve later on and they have some kind of plan for that improving. I appreciate that's very difficult to actually justify, I suppose, or be able to actually project for a lot of employers at the moment. But what we've tried to do is put a policy in place that still keeps within the regulations in terms of actually when things are due to be paid. Because out with that, there isn't really the flexibility regulation-wise yet to actually put anything more flexible in place in terms of employer contribution deferral.
Yeah.
The three months I've mentioned.
Come back briefly.
Yeah.
I fully understand your regulatory restrictions. I just think that we are living in such unprecedented times that we probably do want to try to think if it's possible for them to pay by a certain period that might not be March 2021, then we want to enable them to do so. That's all I was really thinking, and whether the government will put in some sort of allowance for that in the future.
Well, I think that's a good point, Margaret, but I think it's in the hands of the government to assess that. I suspect as that date approaches, someone in government might actually realise that there's an issue here and might consider relooking at that situation and making some adjustments. But from our perspective, we've got to work with what we've got at the moment, and I think the policy addresses some issues which are important. That is, where we can, we're giving people the opportunity to defer if possible, up until the regulatory position. And my question, I know there's 2 or 3 other people with hands up, but I can just follow up with this one. My interest is in once you've reported the employer to the regulatory authority, what happens next?
At the point of reporting, you'd have tried to have kind of done everything you can to make sure the employer has paid or is going to pay anything back that they haven't paid that's due. So at that point, you report it to the regulator. The regulator will essentially ask you kind of what you've done to try and resolve the issue as a fund, and will also kind of ask you what you intend to do to try and resolve the issue in terms of getting back payments from the employer. So essentially at that point you engage, well, you will already have been engaging with the employer, but you engage a lot more with the employer around either some kind of repayment plan so that they can pay it over a period of time, and you essentially have to give the regulator regular updates about kind of how that's progressing and what the situation is.
So Margaret's point about there being a little bit more flexibility, actually there is, in so much as once you've reported it to the regulator, they don't just walk in and start sending in the bailiffs and start taking their computers away. They're expecting the fund and the defaulting employer to get together and find out a suitable way of rectifying the current situation and perhaps giving them a year or so to pay back the amounts that are outstanding.
Yes, at that point, the expectation is that you engage in dialogue with the employer to try and resolve the issue. I think that the issue with actually putting that in black and white and writing in a policy for the fund is that you're obviously kind of not encouraging a breaking of the regulations, but you're kind of putting that out there as a kind of flexibility option. So you have to, I suppose, from a policy perspective, restrict it to kind of the end of March as the deadline.
I understand that, and I think it's a sensible approach. But in terms of a de facto position, we can't just march in and take the money. We have to engage in a process which may well provide the defaulting employer the opportunity to negotiate a way out from that position.
Yep, absolutely. Yep.
Okay, I've got Stephen Bolton first, then Bob Deering.
Thank you. Page 180 of the report pack, I think it's very important that the cessation of payment isn't the first cost-cutting element of any firm, any employer. It's important. I mean, we've known from the past, from years ago, where payments to the pension fund are the first way in which people have tried to save money, and clearly we need evidence that that's not the case. Otherwise, things go from bad to worse. But on a point of interest, you say in the report that interest may be payable. I would have thought that it would be better to be more definite on that at the moment, so that it would lead to less argument later on. So we could say interest would be payment, would be required on payments so many months late, or would not be requirement if paid at a certain time. Just to sort of go to be more definite on that, rather than saying interest may be payable.
Good point, to Stephen.
Yeah, just to respond to that, yes, absolutely, you can put something in the policy. That wording, I suppose, is in the advice part, but you could certainly put a clarifying point if you wish to be kind of definite on it within the policy itself, one way or the other, whether you wish to charge the interest or not.
Yeah. Okay. Thank you.
I'll come back to that in a second when we come to the end and we want to adjust or otherwise the proposed consultation report. Bob, you wanted to make a comment.
Yeah, thank you very much, Ralph. In broad terms, I agree the approach that's recommended. It's obviously quite a delicate balancing act, isn't it? Because once an entity starts to slip, there's a tendency for it to slip eventually over the edge of the cliff, isn't there? So we do need to be careful and cautious. My question is not meant to be dramatic, but I realise I don't know. If an entity goes bust, if it goes into liquidation, what are the priorities? How high up the priority pile is pension debt? Or does that just go in down at the bottom as an ordinary unsecured debt, which would be subordinate, for example, to mortgage liabilities and things like that? In other words, how exposed are we if we give people some slack? Thank you very much.
Yeah, the pension fund is quite high up the priorities. It's not. I don't think it'll be top of the pile, but it's pretty close to the top. So you are still exposed. There is still a good chance that there will be other kind of priority debts that come before the fund, but it does tend to be quite high up the rankings.
Ralph, can I just have a little PS?
Sure,
there?
yeah.
Would you mind if we could have just definitive information on just precisely where we rank in the priorities? I'd find that very helpful, please. Thank you.
If you could include that on the minutes of the meeting. Patrick, do you want to comment on that before I invite John to come in?
Yes. The experience I've had where one of our employers went into administration was that particular employer didn't have any physical assets. Their assets were their staff, and so where we ranked compared to other creditors, HMRC was top of the pile, then individual employees, and then we were somewhere down, further down the line. But the sort of protections you can put in place are you have, under the new regulations, you can have a guarantor, so an outsourcing authority that sources a contract out to a contractor may act as guarantor. There is what we call an insurance bond, which can protect against certain risks that may manifest. Or you can take security over assets, like physical assets, if they are property as well. But that would have to be agreed, preferably before this employer went into administration. The protections now are probably a lot better than they were in the past. Under the old regulations, when a body came into the fund, there wasn't a requirement to have a bond or a guarantor. It's a lot more stringent now.
Thank you, Patrick. John Graham.
Yeah, Chairman, as I read the paper, I'm slightly concerned that and whilst I've been listening to your debate on flexibility, I'm slightly concerned this might be a policy which this committee can agree to, but which may not find itself being used to any great extent. Because I think that at the beginning of the policy, where we list the things that we require the organisation to do to gain the deferral, we set a very high barrier to get people to apply. And I wonder whether by only giving them 3 months deferral, whether the benefits of the deferral match the benefits match the hurdle we put in front to get that deferral. I mean, for example, we're requesting a covenant assessment of the employer, and that takes time and it takes money. You often find that when a cash flow crisis appears, it always appears quickly. I do reflect that Bob said we need to be careful, but I just wonder whether, and I suppose this goes back to your point about whether we've got sufficient flexibility in the time we're able to give, which balances against the barriers we've set for applying for the scheme. Just interested in any comments.
Barry.
Yeah, certainly from my perspective, you could see it as a kind of high bar. I suppose it's mostly a kind of due diligence side of things. From the fund's perspective, you have to make sure that you're seen to be making sure the employer is making efforts elsewhere, making sure the employer has a plan in place to make sure you've got a decent chance of getting the money at the end of the deferral period. It's as much as the idea is to be flexible for the employers so that you're kind of helping them, you still have to have in the back of your mind or rather in the front of your mind, the protection of the fund from that perspective as well. So it is, as was mentioned earlier, a kind of delicate balancing act between enough rigor and an analysis of the position of the employer against the ability of the employer to kind of comply with that, I suppose. And we have tried to kind of achieve that balance but still with having the fund protected by making the necessary kind of having the necessary insight into the employer's position.
I think the bar needs to be set quite high, given that if as you pointed out, we are a preferred creditor. We might not be at the top of the list, but we are, as you indicated, quite high up. And you would not want to relinquish that position unless you'd been certain that the employer had used all other means before seeking to defer the payments to the pension fund, because we'd be undermining our preferred position in that respect. I'm sure, Graham, that John, that the consultation process will draw out from employers any concerns they have over this particular area of the proposals. And might well give us some food for thought when the consultation process is concluded. But I wouldn't want to water down the proposals at the moment until we'd had that consultation process.
Can I briefly come back and say,
yes,
wasn't my intention to water down the proposals? It's just that we're interesting, as you say, to see what the consultation says. But my sense at the moment is the risk-reward line that, as Barry said, we need to find that balance between the mitigating the risk, but at the same time giving us a benefit. If I were an employer, I'd find it slightly balanced towards the pension fund, and maybe that's the case we want it to be. Because as members of the pension committee, the last thing I want to do is be frivolous with our funds. But I just I put that in as a comment.
Thanks, John. Okay, I don't see anybody with hands up. I'm gonna just wind up the discussion by saying it strikes me that it would be helpful before we go out to consultation if Patrick and Barry were to just discuss this issue over making this a general policy as opposed to a COVID-specific policy. And I think the point about the interest on deferred payments, I think it would be better if from a personal perspective, we made that mandatory and then relaxed it if we had to, rather than the other way around. So in other words, people would know that there is going to be interest payable under certain circumstances, and I'm more than happy for you to consider that, whether it's 1 month deferred or 2 months deferred and what the rate might be. But I think that needs to go into the paper as well. Is there anybody who would who would not necessarily agree with that situation? I see Bob is agreed on interest. I'm suspecting that there are others. If you disagree, please indicate. Otherwise, I'll take it that you've agreed. Robin, you're Margaret and Robin. Robin first, then Margaret.
I was merely indicating I agreed with the interest and then relaxing it in an individual case if that was thought to be a good thing to do.
Right.
That's what I was indicating. I agreed with what you were saying, really.
Thank you, Robin. Margaret?
Okay.
Yeah, I think it should be much clearer, as Stephen Bolton said. I think we should be definite about when we're charging interest, but I also think we should allow a period to give them incentives to try to pay before interest is charged. So, for instance, say 2 months or something, or to notify us and, you know, to actually see what their position really is. But it is an incentive, you know, to be upfront about the interest and after what period of time we charge interest. I would suggest.
Thank you, Mark. I think that's a wise position. Patrick, Barry, can I ask you to deal with those two issues before we go out to consultation? And if necessary, you can consult the working group members if you think that it's necessary to do so. Is that okay, Patrick?
Yes, that's fine.
Great. We are. Let me just check this. The Pension Committee has noted the content of the attached report and agrees that the draft exit credit policy. Sorry, I'm on the wrong one here. Or am I? No?
Yes.
Yes, I am. One
Chair,
before.
you're on the wrong paper.
Yes. Contributions deferral policy. That the deferral policy for the Hertfordshire Local Government Pension Fund. Is this? Are we going out for consultation on this one?
We weren't going out to consultation, but no, we weren't. We are going to ask for consultation on the next agenda item, but what we can do, we can send this.
Got mixed up. Okay, it strikes me that it's worth just writing to to members and getting their views on it. As John Graham pointed out, it could be that they have specific issues in relation to timing and so forth. So worth just writing to them at least and asking them if they have any comments on the proposals. And just adding as a further recommendation that you address those two issues that we've drawn up and include them into the policy before it's consulted on.
Yes.
Elaine, are you happy with that? Just waiting for her to confirming in chat. Yes, fine, thanks. Good. Okay. Thank you, Barry. I'm assuming that your colleague is going to be taking up the funding strategy statement. So I'll hand it over to Patrick and then further on.
Great. Okay, thank you, Chairman. So the next agenda item is with regard to exit credit policy. The members of this committee agreed the funding strategy statement back in March this year, which does seem some time ago. Contained within that funding strategy statement, which is a document which explains how we set contribution rates for the employers within the scheme, how we pool certain employers, how we engage with them. Within that document, there is an exit credit policy, and an exit credit crystallises where at the end of an admission agreement, when there are more assets than liabilities. And up to recently, we were not required to repay a surplus that stayed within the fund. Regulations came in back in 2018, which required the fund to pay an exit credit if there was a surplus, and so that exit credit was calculated by the actuary and we paid that credit out to those employers. However, post the approval of the funding strategy statement, further regulations have now come out which sort of muddy the water to an extent, in that they give the fund discretion with regard to how that exit credit is arrived at, how it's valued, and it takes into consideration whether employers have paid all their contributions. If they haven't, they are to be deducted from that exit credit, and other factors as well, which I'll let the actuary talk about. As this is a policy that is changing and it impacts the funding strategy statement, we are required to consult on that change with the employers in the fund, and hence why the recommendation sets out that the members of this committee approve the draft policy and agree for it to go out to consultation. I will hand over to, is it Catherine who's now going to, right, I'll hand over to Catherine who can explain this in a bit more detail.
Thanks, Patrick. Okay, our advice, similar to the last item, your agenda pack contains a little bit of our advice on the topic, followed by the draft policy. So the advice, I think, starts on page 185 of the agenda pack. As Patrick alluded to, this topic has been subject of a couple of amendments to regulations by MHCLG in recent years, and it's maybe helpful if I just explain a little bit of the background to that, because it explains why the policy is the way it is. As Patrick said, prior to May 2018, if an employer left the fund, there was no facility for the fund to refund any money to that employer. So regardless of how well funded the employer was and how many assets they had relative to their liabilities, there was no facility for them to receive any refund. Government legislated and said that didn't seem fair to employers, and they produced some legislation that said in the event that an employer was leaving the fund and that the actuary assessed that there was a surplus in the fund, so there was more money in the fund than we believed at the time that they left was necessary to fund the payment of benefits to their members, then that money should be given back to the employer. The issue with the regulation was it was absolute, and it didn't take into account, for example, any arrangements that the employer had entered into with the council outside of the pension fund. So there were situations where in bidding for a service, the employer had entered into some kind of contractual arrangement with an outsourcing council, but there was no way for the fund to reflect that. The fund had to pay the exit credit to the employer, even if, for example, the employer wasn't liable for any exit debt that had arisen. So the regulations were absolute and very inflexible. They also, the regulations that were brought in at that time didn't take into account the fact that many of these employers, again, had entered into commercial contracts that predated the regulations. So in bidding for the service, they were aware that there was no possibility of an exit credit and had factored that into the price that they offered to the council. And so a few of them, again, there were some difficult situations arose as a result of that. So this piece of legislation that we're now responding to and adjusting our policies to take into account intends to give the administering authority more flexibility to take into account some of those external factors. And so in particular, it has given four things that you can take into account in determining the amount of the exit credit. So point A is, in fact, the size of the surplus or excess. So that part that we talked about before, the extent to which there's more assets in the fund than we believe are necessary to pay the members' benefits. And we would suggest that would provide a very natural upper limit to the amount of any exit credit. Point B that's there is actually on the face of it, it seems quite straightforward, but it's quite, depending on how long the employer's been in the fund, could be quite complicated to calculate. It says that the administering authority should have regard to the extent to which the surplus has arisen as a result of the value of the employer's contributions. And that may seem straightforward until you think about some employers may well have been in the fund for 20 or 30 years, in which case calculating how much they've paid in contributions is pretty onerous. Some of them may have been in for a short time and only paid a small amount of contributions, and therefore you may well want to use that to limit the amount of any surplus that goes back to them. And again, the other thing that we have to take into account is that even if, for example, there is a surplus in their share of the fund, it may be because the fund has performed exceptionally well in investment markets during the period of that employer's participation. And so then there becomes a question of, should that employer, for example, be allowed to participate in the fund for free of charge for 2 or 3 years just because the investment return during that period was very strong? So there's quite a lot to think about in terms of to what extent the surplus effectively kind of belongs to the employer or has arisen because of the value of employer contributions, or may have arisen for another reason. Point C talks about representations made to the administering authority by the employer exiting. So that allows any risk sharing arrangements that have been agreed perhaps with another employer in the fund to be taken into account. And then D is a kind of catch-all that allows you to take out anything else that's relevant. And we've suggested things that might be relevant where the regulations that were in force when a contract was priced, and certainly any unpaid contributions or unpaid debts to the fund, we would argue definitely should be taken into account. So with those points in mind, the draft policy statement is set out from, I think, page 189 in your pack onwards. It basically sets out the process that the fund will follow. It highlights some of the things that I've talked about in those earlier my earlier comments, and explains how they will and won't be taken into account. Got to be careful not to fetter discretions here, because it is a discretion that the fund has to pay the policy, but we've tried to set out the kinds of things that will be taken into account and the process that will be followed. Happy to take any questions.
Catherine, can you hear me?
Yep.
Right, I'm just not sure whether we've lost the link. Chairman, are you on the line?
I can hear you fine.
Yep.
Okay,
Sorry,
thanks.
I apologise. I'd forgotten I'd turned off my mic and camera. Catherine, thanks for that. I'll just repeat what I said. It strikes me that we've got a little less flexibility in this policy. It's drawn up in accordance with the statutory instruments that have been prepared in relation to changing the situation. Therefore, could anybody, any member of the committee who wishes to ask a question, please indicate? Margaret.
Sorry, I'm still not quite. Is this discretionary or is it statutory? Do we? It sounds like there are so many sort of different contributions to this that are a little bit arbitrary or discretionary and up to us. And I was just, I'd quite like a bit more clarity as to, when do we have to pay, and is it I actually would like to see a little bit more about the communication that employer makes with us if they know that they have liabilities and haven't paid but are actually trying to pay, that they should actually be given some credit for that. But I'm not exactly sure how hard and fast, what is decided by regulation that we really then have to give them an exit credit voucher back again, effectively.
So I think what government's done in this latest round of legislation is really given the fund quite a lot of flexibility. That final catch-all that says you can take into account basically anything that you think is relevant means that a lot of the power to decide this sits with the fund and with the administering authority. I think it's safe to say that with such flexibility, there's likely to be employers who challenge this, which is why we've gone ahead and put a policy in place to set out the process that we'll follow, or that the fund will follow in determining it. I'm aware that there's already a couple of employers in other funds who are taking legal action against the fund in the way that they've determined these exit credits. It's a particularly messy area now.
Perhaps, Margaret, I misled myself in so much as I didn't mean flexibility from our point of view. I mean the flexibility. The government have put down the reasons by the terms of the arrangements. Our flexibility is in interpreting them. So and clearly, whenever there's interpretation, then there's going to be a legal challenge. Potentially to the way in which they have been interpreted. So I guess that's where we're going in terms of the employers who have already concerned themselves in relation to this this change in policy by the government. Patrick, I see you've got your hand up. Was that a comment you wish to make?
Yes, I just wanted to add that the purpose of the the development of the policy is to preempt these sort of challenges, in that we set some rules of engagement with those employers. So when they come to the end of their admission agreement, they have a full understanding of how that conversation, negotiation, so to speak, will take place around the determination of the value of the exit credit. I think it's very important to understand that there may be other parties impacted besides the employer, such as the outsourcing body, so it may be a district or a county council who has agreed perhaps a fixed rate policy with that employer, in that for the duration of the contract, that employer pays a fixed rate, and through the benefit of assets and markets, they may have got to the end of that agreement and there's a surplus. Now, would that be fair for that contractor to walk away with a surplus when the county council or district council has acted as a guarantor in the background, in that they would accept to take all the liabilities in the event of the end of the contract? There is a liability position. So I think, there is a lot of discretion here, but I think those discretions add some value for the administering authority in those effective negotiations with those employers. So the policy preempts and sets the ground rules, in my view, for those negotiations. And it's important that we consult with those employers before it comes into effect. And so what we'll do is there is a consultation period. We'll bring this back to the committee at the end of the meeting in November, and make you aware of any challenges or comments that on that consultation, and flex the policy potentially to reflect those comments if we consider them to be valid.
Okay, I've got Bob and then Margaret.
Thank you, thank you, Ralph. I just want to make sure I'm understanding this correctly. I hope you can hear me there. Am I loud enough for you?
Yeah.
Yeah. Okay. So am I right that what's happening here is that maybe an employer looks at his pension numbers, realizes there's a surplus in the fund, says to himself, "Oh, I'm going to close this down because I'd quite like to get this surplus back. I'd like to have it." When the employer gets that surplus, does it just go into his own books, or must he distribute it to the individuals who otherwise would have been beneficiaries under the pension arrangements? And if he can put it into his own books, is there an element of this that we need to be cautious about?
So the situation, as you've described it, can happen. I've not seen it happen in Hertfordshire, but we've seen it happen elsewhere where exactly that. A contractor enters into one of these agreements. There's maybe very strong market returns in the first period of the agreement. The contractor looks at their pension position and thinks, actually, I can make a bigger profit on the pensions than they can make on the contract I'm running. And so we'll maybe just draw a line under this just now. That has happened elsewhere, particularly when the rules were just blank, you must give the employer the exit credit. And I think that's why government tried to bring in this legislation, which effectively gives the administering authority the power to say, well, no. So one of the reasons they may withhold the exit credit, for example, would be because it was terminated at short notice, contributions over the period. And as Patrick pointed out, that it's not just a two-way thing between the employer and the pension fund. Quite often in those cases, there'll be the third party of the outsourcing employer, whether that's Hertfordshire Council or another employer in the fund. They're effectively a third party to that agreement as well. So the policy, as Patrick says, sets out the steps effectively will follow in determining whether or not to pay that exit credit or to what extent to pay the exit credit. To your other question, the exit credit goes wholly to the employer. It doesn't go to any of the members in the pension fund. Their benefits are fixed. They do get the benefits that they've earned during that period, but they don't get any extra benefit.
Okay, thank you very much. So it must be sensible for us to have a policy then.
I think so, yeah.
Thank you all. I don't see any more questions. Margaret's, oh no, Margaret put her hand up and took it down again. Margaret's put it back up again, so I guess she has a question.
Yeah, I see this very like the admissions agreements, actually, that I think we are trying to preempt things and put in conditions to help employers really understand that we really want to be fair. And I think it's really important that that is seen to be our goal. But I actually am not sure that we've got enough in this at the moment, because I do think that employers, I mean, particularly to do with outsourcing and how contracted, you know, when things that were within the county council, within a borough council, have been outsourced, and the company hasn't properly thought about pensions. I'm interested to know how many of those 15 that still haven't signed up to admissions agreements are actually contracted outsourced companies. But in this case, it's very similar, that I think we need to try to be as careful as we can and put in policy that involves dialogue, that we understand they have really understood their obligations and are trying to pay their employee contributions properly. And I think there should be some allowance for that, in historically looking back over however many years they've been signed up with the pension fund. That bit isn't really written in at the moment, but I think,
Margaret, it's implied. I think Catherine mentioned earlier on the consideration of how long a member had been a member for, an employee member, would be taken into consideration, and how short a period of time someone was an employee member as well.
Yeah, it's not just the length of time, though. It's actually their diligence in corresponding with us should there have been a problem, or they, you know, are actually strapped for cash, as might be possible in COVID.
Well, I think the catch-all last item, I think, is the one that gets you into that position of being able to consider all issues in relation to the relationship between the employer and the fund.
Yeah. Okay.
We are going out for consultation on this, so we'll be interested to see how employers react to the proposals. And given that we've also included the deferral policy as a consultation policy as well, the two of them really go together in terms of the way in which we're going to deal with issues such as this. So the fact that they're going to be consulted together is probably a good thing.
Yeah.
Okay. Does anybody else have a question? Otherwise, I'll move to the recommendation, which is I think the committee is to note this and agrees to the exit credit policy being consulted on, etc., etc. So I can't see anybody deferring from that, so I'm going to assume that that's agreed. And we are at 12 o'clock noon. I'm going to propose that we have a 10-minute break before we move on to the next item on the agenda. So could we reconvene at, say, 12 for the next remaining items, please? See you then.
And that, Ralph, was the reason for my feedback. So sorry about that.
That's okay. I got your chat message.
In chat. Yeah. Okay. Right.
Thank you, everyone. We're back live broadcasting. So I think we reached the point at which we were going to consider the actuarial update on the McLeod issue, which I think some of us are familiar with. Patrick, I think you're going to take this initially and then pass it on to Kat.
Thank you, Chairman. So as a brief introduction for members of the committee, you'll recollect that at our informal committee in July, the actuary presented some background to McLeod, and as a quick recap, the McLeod judgment is a result of an age discrimination case that was appealed. The judgment was appealed by the government to Supreme Court, and the government lost their appeal. It was decided by the government to apply the judgment across all public sector pension schemes. The original case was brought by the judicial scheme and the fire schemes. So the government agreed to apply the judgment across all public sector pension schemes. The actuary's paper aims to explain both the financial and administrative consequences of the judgment. From a fund perspective, the judgment will have a minimal impact financially of perhaps around £5 million. However, the impact from an administration perspective is a lot bigger, and there'll be an impact on individual employers, which may be different dependent on the characteristics of their membership. The impact of the judgment on the scheme membership, the actuary believes it's up to 25% of the fund membership which will be impacted. And what this means is that we'll be required to review all the benefit records of that 25% of fund membership and reinstate their benefits to apply the judgment from the period 2014 to 2022, where the underpin comes into effect. Now, this is administratively, it's a very big exercise. I've been in discussions with LPP, the scheme administrator, and they are developing setting up a project team to address this big issue to recorrect the records. We will have to look at employers, talk to employers to get the historical payroll records. We'll also have to do a lot of communication to a number of stakeholders, such as employers, members that have been impacted by this. Some of those members may be receiving pensions which will need to be adjusted. So administratively, it's a big exercise and could take a number of years. The government is consulting on regulations at the moment, and we don't know when those regulations would come into effect, but I would say it'd probably be the start of the next financial year. That's all I was going to say in summary, and was going to hand over to, I think it's Catherine, who will go into a bit more detail on this.
Thank you, Patrick. The paper, I think, is from page 193 in your pack. We did talk about this back in July. It is complicated, so I'll recap a little. As Patrick said, the area of the scheme that has been found to be age discriminatory is the transitional protections that were awarded to those members that were within 10 years of retirement when the new scheme came in. And what they were given was an underpin protection, and what that said was that over that period until they retired, and that period ends on the 31st of March 2022. Over that period, at the point when they retire, the pension fund will calculate a better of two benefits. It will calculate the better of the new scheme benefit with its accrual rate of 49ths and CPI revaluation, and what they would have got in the pre-2014 scheme, which was a 60th accrual rate, but that gets revalued each year in line with the members' own earnings. So those members that were within 10 years of retirement had that underpin. Now, as it happens, actually, over the period since the new scheme has been in force, so since 1st of April 2014, the new scheme has, for the vast majority of people, been the better option. So the underpin of you can get the benefits in the old scheme if they're better hasn't actually come into being, hasn't been the better option for the vast majority of members that have retired in that period. But notwithstanding, that has now got to be applied to everyone who was in the scheme as at the 31st of March 2012. So that's the nature of the underpin and that has to be applied. As Patrick said, the government has lost all its court cases on it now and has accepted that this remedy has to happen. And in July, MHCLG and HMT actually published consultation documents setting out detailed proposals for addressing the discrimination and how this was going to work in all the public service pension schemes, but of course we're most interested in the LGPS. So again, what they've basically said is that in order to address the discrimination, that underpin, that better of underpin that applies between 1st of April 2014 and 31st of March 2022 now has to be applied to all members of the scheme, regardless of their age. And the change is retrospective, so it will apply to anybody who has left the scheme during that period, whether that was, so they wouldn't have retired on normal grounds because they wouldn't have reached that age during that period, but anybody who left the scheme to transfer to another pension scheme or to move job, or anybody who's sadly died in service, or anybody who's had an ill health retirement. So anybody who's left during that period will also apply to them, as well as the members that are still in the scheme. As Patrick alluded to, there is significant complexity in calculating the detail of how that underpin needs to be calculated. We will have to collect data from employers regarding the salary and the service and the hours of everyone who's been in the scheme over that period, so that we can do the calculations and see, first of all, whether any underpin has already crystallised and should have been brought into payment. But importantly, although the period of service that's protected is only up until 2022, we need to wait until those members finally leave the scheme to make sure to know their final salary when they leave, so that we can test which of the two sets of benefits is better. So there'll be a retrospective part of this project, making sure that we've calculated the benefits correctly for everybody up to the date that we're doing it. But going forward, we will also need to keep applying that underpin until the last person who was in the scheme on the 31st of March 2012 has left. So this is, as well as the immediate project to calculate the arrears and any benefits that have been calculated incorrectly, we will also have to carry this on well into the future. As Patrick said, based on, we don't consider that this will have a huge impact on funding. So in terms of liabilities, it might increase it by around 0.2% of the fund's liabilities, or maybe about £5 million across the whole fund. The reason that it's so small is what I spoke about earlier, actually. For the vast majority of members, the benefits in the new scheme are more valuable over this period than the benefits in the old scheme. And that's largely because pay growth over that period since 1st of April 2014 has been really quite small. And you would need pay growth to be quite substantial, because it needs to outweigh the fact that you get a larger accrual rate. So the benefits tend to be better in the new scheme for most people, and therefore the chance of the underpin actually biting is quite small. It does bite for some members, and one of the features of this going forward, and one of the kind of risk factors going forward, is that if there is substantial pay rises in the public sector, then more people may well be caught by that underpin, either in the next few years or in the longer term. Obviously, because it now applies to younger members in the scheme as well, the probability of their final salary or their salaries over the course of their career outpacing inflation is much higher. But nonetheless, it's not really the funding strain that we're particularly worried about, although we will monitor it as a risk. It's the administration impact that's going to be most material, certainly in the short term, set out on page 196 of the agenda pack. Some of the steps that will need to be followed in order to implement this remedy, including identifying everybody who was in the scheme at that time, and then collecting the data that we needed to adjust their records and to calculate the underpin. So we've only got enough data just now to calculate their career average benefits. We need the extra data in order to be able to calculate the benefit they would have got in the old scheme. So that recalculation process will have to happen. Some of them will be calculations will be complicated by members leaving and coming back, having multiple services, aggregation across multiple records, all the usual things that complicate these types of calculations. There may be some pensions already in payment that now need to be recalculated, and so there may well be arrears and interest calculations and payments of arrears due to some members. Another complexity that will have to be addressed and taken into account is that where some members' benefits do change as a result of the underpin and their benefits may increase, and the people that may well fall into this category are people who were maybe just slightly younger than they needed to be, so more than 10 years away from retirement back in 31st of March 2012, but maybe fairly far on in their careers, who've had significant promotions or significant increases in pay over the last 6 years or so. Those people may well now find that their benefits under the old scheme with its link to final salary are better than the new scheme. And if that's the case, and it's a substantial increase in the benefit, then they will also be liable, maybe have an annual allowance charge to make as well. So there's going to be a tax element to this that needs addressed too. So we'll need to go back and look at the tax situation too. As you can imagine, there's going to have to be a significant amount of stakeholder communication. I guess there's a number of main stakeholders. There's the members, first of all, themselves. There's also the employers. So LPP, your administrator, is going to have to go to every employer in the fund and ask for this historic data. And at a national level, there's some awareness that some of this data may actually just be impossible to get now. That if we're talking about asking employers for data on members who maybe left 4 or 5 years ago, they happened to be in the scheme on the 31st of March 2012, they were maybe in for a little bit in 2014. The employers might not even exist. If they do exist, they may not have the data. They may have changed payroll provider and so just be unable to supply the data. And that actually is one of the elements that we, Hymans in particular, will address in the consultation is what is to be done? Is there some sort of national assumption to be set around what to do if we can't get all the relevant data to do these calculations properly? Because I think the guiding principle in it has to be that we need to make sure that none of the members miss out on a benefit that they should be entitled to. So I've kind of cantered through that. I really just wanted to give you an impression of, first of all, the amount of work that needs to be done in this is complicated. I don't think there's a way around it. I think this is kind of imposed on government now by this court ruling. And our view is actually that the way they've addressed it is probably the only way that we can address it. In some of the other public service schemes outside the LGPS, it is more complicated because the nature of their protections was different. In some cases, they've actually closed a scheme and brought members into a different scheme, so they're going to have to tackle that slightly differently. But it's small comfort because I think in the LGPS there's still a substantial amount of work to be done.
Catherine, thank you. I don't know about the other committee members, but I think I'm not sure I could frame a question in relation to that account of where we are, because there's so many complexities in it that it strikes me that you're just going to have to work your way through it. But I'm sure someone will, and I've been confirmed in that Margaret would like to make a comment.
Sorry, am I on? Yes.
What you were.
I would have thought somebody would have produced some software for this by now, because we've been known it was sort of happening. So I had two questions really. Is whether there was some algorithms that we can buy to help soften the blow of the admin, which is to do with somebody else writing the software to calculate it. But I also then wondered, you've mentioned that maybe the employer didn't keep records 5 years back, but I suspect the employee may be able to produce evidence of their salary, and how you could actually accommodate that.
On the point on the software providers, there has been a significant amount of liaison with the software providers on this. They have been reluctant to start building anything because as where we're at just now is the government is consulting on its proposed remedy. And I suppose if you're a software vendor, you maybe don't want to commit to a substantial effort until you've got actual regulations or at least some level of certainty around what the proposed solution is going to be. So there's a little bit of the timing issue. The estimate from the software vendors as to how long it will take them to bring this coding into the software is around 12 months. So it's going to take them about 12 months of effort to bring this forward. That will help in addressing the calculations part of it. I think probably the bigger parts of it that were going to be the data collection. Actually, once we've got the data, crunching the numbers wouldn't be too difficult. It's actually collecting that historic data that's going to be the bigger challenge, which leads me on to your point about the members providing some of it themselves. Again, that's a huge exercise, and you can imagine how that may be. They may have a bit of a pay slip from here, a bit of a pay slip from there, and what we actually need is consistent data on a month-by-month basis to know what they're doing. I think that's one of the things that the government will receive back in its consultation response is that bit of what do we do when the data is very hard to come by or impossible to come by, and how do we ensure that members don't miss out on benefits they're entitled to. So there may well have to be just some kind of bias towards the member when we address this.
And just to say, I think it will be in their bank account. I just think that there may well be accounts that can be traced, but I just was thinking, being flexible about thinking where will the source of the data come from. Yeah.
Mark, remember the estimate was that 25% of the members were going to be affected, and 25% of 109,000 is a lot of people, and working through just bank account statements is probably not the best way of collecting data, but it may be the only way of collecting data, and where I suspect that's going to be the case, they may at least try.
No, I mean, the employer is obviously your first port of call, and you hope they've kept records for 5 years or more. Well, in fact, 10 years you're really wanting records of. But if they haven't, rather than, doubling back to some government, compromise, it would be better to try to get the correct data, if possible, then verified by the employer. But, getting the employer to, if possible, help you and possibly use the employee. But anyway, it's just because I have been somebody to track data in the past, I can think of lots of ways that you might be able to get it. But I agree, you don't really want to have the job of crunching through bank statements if you can help it.
Okay, thanks, Margaret. Anyone? I don't think there's anyone else on the line, so I'm going to assume that we've noted the contents of the report, and jolly good luck, Catherine, with that one.
Thank you.
Okay, we're going to move on to item 9, which is the access update. Patrick, I think this is your position, your report, and you can take it away.
Yes, thank you, Chairman. This is the quarterly report that comes before this committee. Conscious of time, but I'll canter through it and draw out the salient points. So, the access, you can hear me, can't you? Yeah, my microphone's on, sorry. So the access pool, total assets in the pool sub-funds with Link are around 1.6 billion. Total assets under access pool governance, which includes our passive assets that we have with UBS, amount to £3.5 billion. We have since June, however, removed just under 500 million from the passive management with UBS to fund the equity option strategy, and we'll talk a little bit more about that in part 2. And however, the fund has invested £300 million in the Longview Fund, which is a sub-fund within Access, and that was funded by removing assets from the Allianz mandate. Total assets in the Access pool is now circa 13 billion of sub-funds, which is really hasn't moved since the last time we reported to committee. During the sorry, I'll switch my video on. Helped. During lockdown, section 6 explains how. Sorry, let me just go back. Section 8 explains how Access has been working during lockdown. There has been a number of virtual meetings in a similar way that this meeting has been conducted today with the joint committee. We've had 2 of those meetings. There's been regular briefing calls with the joint committee chairman and vice chairman, and there's been updates to section 151 officers with virtual meetings as well. Officers have the ability for officers to progress work at a pool level has been affected by the lockdown, and the ability for those officers to progress certain aspects of work. However, officers have been meeting on a weekly basis in a virtual format, and those meetings have enabled us to progress work as well. You will see in section 5 of the report, if I turn to 5.7, at the last meeting of this committee back in March, I reported an issue with regard to tax savings from the pooling of the Baillie Gifford Global Equities mandate, and that the savings had been overestimated, and they had been overestimated by £900,000, which was disappointing to hear first from the fund when Link presented actual numbers to us. This was raised at the joint committee, and we have subsequently had some form of explanation from Link, which is attached as Appendix A to this report. That said, I would be quite clear. I want to make it quite clear that we would have still pooled this mandate because the management fee savings were significant, and you'll see in table 2 on page 204 that the savings are over £1.1 million a year. Total savings from the pooling of assets to date are forecast to be about 1.3 million per annum. So if I touch on section 7, the Access budget, you'll see on page top of page 206, the Access budget for the year. We're currently underspending that budget. There has been, because of COVID impacts, certain pieces of work have been impacted by our ability to progress it. We've been doing virtual calls with consultants. There is another issue that has impacted our ability, or Link's ability, to launch sub-funds, which I'll touch on in section 10, which is on page 209. But prior to getting to that particular point, as I said in section 8, talk about how Access has been working during COVID, during the pandemic. It has had an impact. One of the minor impacts was we had to pull the investor meeting, which members of this committee attended back in October. We were going to have a second one. Link are proposing to set up a virtual meeting of investors, and so that you can still engage with the managers that manage the funds on behalf of Access. Section 9 is the pooled assets. So if you go to the table on page 208, you can see that just under 70% of Access Hertfordshire funds are in the Access pool, and that will progress as we will get larger as we move further assets from Allianz, for example, and when we have a review of the LGT mandate later this year. Illiquid solutions, the pooling of private equity and property. We've started work on those solutions. We are working with an external consultant on the development of how we pull future investments in these particular asset classes, and I'll report back to this committee at a later date on progress with regard to the pooling of those assets. I want to draw your attention to section 10, and it's with regard to insurance. And this is a particular issue that's emerged in that Link, the operator, is required to hold a level of professional indemnity insurance, which is equivalent to just under 1% of the assets under management. The issue is that Link are required under the operator agreement we have, each fund has with them, to get a form of insurance with an insurer that is rated A+ by a credit rating agency. 10.1 gives a bit more background there as to that type of rating. Now, as the assets under management have increased, Link has struggled or is struggling to find appropriate insurance at that required credit rating. We've commissioned some external consultancy from an insurance broker. We've spoken to our legal advisors, but in particular with regard to the third-party advice from the insurance broker, he has said that that market has become more constrained at A+. There are less providers in that market, in that type part of the market, and Link have actually approached us to ask us, would you consider, or will you consider reducing that requirement to A-, as that will open up the number of insurers that we can get this coverage from. So you will see in the recommendations that there's a second recommendation that we approve that downgrading. The impact is that if we don't agree to this, Link will not be able to provide the relevant regulatory level of insurance, and they will not be able to launch any new sub-funds because they won't have the correct level of insurance to cover those new sub-funds and assets under management. This was discussed at the joint committee, which took place last Monday week, and it was agreed by the joint committee that once the contract manager has discussed this further with Link, and it's linked to another issue around developing additional performance indicators, that once it has been confirmed by the contract manager that that's agreed, then all funds should sign off their operator agreement to allow that change. So the main issue here is that if we don't agree to it, then basically we come to a full stop on the launch of future sub-funds, which we don't want to see. Section 11 on the top of page 210 explains, gives some narrative to something that some members of this committee might be aware of. There's been a lot of news in certain broadsheets, such as the Sunday Times and the Financial Times, with regard to class actions that are being potentially brought against Link, the corporate director, the authorised corporate director of the Access Pool, and Northern Trust, the depository. As the background to this is that the Woodford Fund, which I'm sure most members will be familiar with, was gated last year, and certain legal firms are consulting with retail investors as to joining a class action against Link in particular. We are in dialogue with Link with regard to this, but to be clear, this does not have an impact on the Access Pool. It does in the way that it is adverse publicity, that it's on the radar of Access and we could be asked to comment on it. But the assets that are under management are in the custody of the custodian, and Link does not have those assets under custody. Link is the director, the authorised director, who sets up the sub-funds, who puts in place the reporting and the accounting, and allows funds like ourselves to make subscriptions and withdrawals. That's their role. The Northern Trust, the depository, is the custodian of the assets in the pool. that's all I was going to say, but to draw your attention to that recommendation, the second recommendation with regard to the insurance, and pleased to take any questions that members may have on this report.
Okay, anyone who has a question regarding the report, please indicate. So I take it that there isn't anybody. Certainly on my two screens here, I can't see anybody. Ah, Margaret, you wouldn't let me down. I knew it.
Sorry. I just find it strange there is no insurance company that would be an A+ company. And I just wondered, I mean, I realise, you know, all our assets are getting much bigger and Access is a huge fund, but is there nobody who had that vision to be an A+ insurance company?
Can I?
Yeah. Or I'll answer it, whichever.
We can do a dual approach to this one.
A stereo job,
yeah. So there is insurers at A+, but the number of providers in that marketplace has reduced, and so that our ability to get that access of coverage at A+ is being impacted by that reduced number of providers. Why is there limited number of providers? Well, sometimes these insurers get downgraded from an A+ to an A-, and so Link have basically said they're really struggling to get that coverage at A+, so they've asked us to relax to a certain extent our requirement so that it opens up the marketplace to include insurers at A and A-. There are providers at A+, and Link will try and source that insurance at A+, but when they run out of those providers, they need to find the insurance somewhere, and it means that they have to go further down into sort of A and A- providers.
The amount we've got insured at A+, I think, is about 10 billion, and we need 14. So the proposal is that the balance is at the lower rate, not the whole of the amount that we're seeking to insure. So where it can be obtained at the A+ rate, then they are acquiring it. It's the balance that we need to increase it by that we're seeking to cover at A-. Bob.
Can I just
sure.
quickly ask why it looks like we may well be using the same A+ insurance company, but now being deemed to be A-. I just would like to know why they have gone from an A+ to A-, because it's that reason that might actually mitigate them, if you see what I mean, and we don't know that.
Patrick.
Yeah, it's purely the number of providers there. So if you've got say you've got 7 providers at A+, and they have provided that level of insurance, if that number of insurers now reduced to, for circumstances that their credit rating's been reduced to 5, and Link can no longer, that insurer says, well, we can't cover you any further. So that reduces that number of providers in that space. So they then have to go down to the next set of providers, which will be at A. But to be clear, Ralph, I just want to, to correct you, Chairman. The insurance coverage that we have at the moment is sufficient to cover assets under management and up to 20 billion. It's over 20 billion. So what we're trying to factor in is future increases in assets under management and also the launch of future sub-funds. We're trying to get enough insurance in place to accommodate that increase in assets under management.
Sorry, Patrick, I was doing it from memory. Bob, you wanted to come in then?
Yeah, thank you very much, Ralph. I understand the point here. It's to do with supply and demand of insurance provision, isn't it, and capacity in the market. This is a very big insurance line that we need. I'm just wondering, if I may say, Ralph, to Patrick in particular, what do we know about the reinsurance market that would lie behind whoever might be the primary insurer of this? Is the suggestion that there isn't much of a reinsurance market? Because if they can reinsure it out, then their problems start to go away.
Councillor Deering, I can't comment on the granularity of that. It's a question that we can ask of Link. Link as a holding company, they have sufficient insurance at a holding company level to cover all the different retail investor funds they manage, plus the Access pool. But Access, when we set up our particular operator agreement with them, asked for a bespoke pool insurance arrangement, even though Link can have got cover for all of their retail funds plus Access. So we were specific in saying what we wanted, a bespoke pooled solution for Access. And we specified that at the time. We consulted an external broker, and he said, I suggest that you get this insurance cover at A+. And at the time, the market had sufficient supply of those providers. I suspect you're right that in the background, these these insurance companies reinsure with other insurers. But I don't know that granularity, because this is a Link insurance solution. They will discuss that with their insurance brokers. We don't have that information.
With the chairman's permission, could we just gently understand what is the reinsurance position in the background? I think it would just help us in terms of our understanding in general.
I'm sure Patrick will be able to ask that of the...
Yes, I don't expect you to know now, Patrick, but if we could just sort of find out going forward.
Yes, I will.
Okay.
Thank you very much. Thank you.
Thanks, Bob. I hope there are no further questions, because I'd like to move on. We are running short of time. So the two recommendations are as in the order paper. Are we happy to accept both of them? And can you indicate whether you do not agree rather than agree? Okay, there don't seem to be anybody disagreeing with that, so I'm going to assume we are all in agreement. The next item is item 10, Stewardship Voting Engagement Report. Patrick and I think Peter is going to be presenting this one.
Okay, thank you, Chairman. This is part of the development of the responsible investment policy work. It's we said, I think, in the July informal meeting that we would bring a stewardship report to this committee for your consideration. It sets out some detail that you may have seen before, but some more specific detail around how managers have voted during the past year. It gives you a further recap on the carbon footprint analysis, whether some of the managers are signed up to the stewardship code, and some points for consideration by the committee as to next steps. So I wasn't going to go into too much detail. I was going to hand over to Hill Gaston, who is from Mercer and their responsible investment specialist.
Thank you, Patrick. Thank you, Chair. I'm going to keep this brief, partly because I can't hold on much longer past 1 p.m. So apologies, but Peter is around if there are any specific questions once I've left the meeting. If we start on page 217 of the meeting pack, this just really gives an overview of the purpose of the paper. And I think it's just worth mentioning that, we've been on a bit of an RI journey, responsible investment journey, over the last 12 months or so, where we've had a belief session. We've used that to update our policy. And really where this paper is focused on is the process side of things, where we've looked to create what I would describe as a baseline. So a baseline across stewardship, so really understanding how well your managers are voting engaging, ESG integration, and this is where we've used Mercer's ESG ratings to not only understand the ratings for your mandates, but how they compare to their peers. And then finally, carbon footprinting, which is really a bottom-up approach to understanding the carbon risk within your equity and to some extent your corporate bond mandates. And we've tried to keep this exercise really practical and help you establish priorities for improvement, as well as looking at ways to engage your managers. Page 219 just provides a traffic light overview of the findings, and I'll leave it to Peter to discuss any manager specific questions that you have. But as you can see, we've basically summarized the various results across our ESG ratings. A lower rating, a 1 or a 2 is the best rating, and then a 3 or a 4 gets you to the other end of the scale. We've looked at your manager's approach to stewardship by thinking about 3 categories, and focused on your equity managers really here for the first 2. So the first 2 have really asked the question around whether your managers are voting all the votes they're able to, and the overwhelming answer is yes, which is positive. The second one around vote disclosure is really assessing how well the managers are reporting on the voting that is being undertaken. Are they doing this in with a sensible policy in the background? Are they voting across the E, the S, and the G, so the environmental, the social, as well as the governance considerations, as well as other areas that you'd expect them to be thinking about? And also thinking about engagement. So not only using the influence that they have in terms of voting, but also engaging companies meaningfully. And you can see for this bit of the analysis, we've extended that engagement question to your corporate bond manager as well. We've got this other column, second to last, around the UK Stewardship Code. And it's just worth saying that we've asked the question of a number of your managers whether they're planning to report in line with the new Stewardship Code. And this new code is really a step up from the 2010-2012 version. The previous version was very much focused on policy statements and thinking about listed equity. And the new code is very much focused on reporting activities and outcomes, so actually demonstrating progress and going beyond just listed equities to include other asset classes where managers can use their influence to improve what the underlying holdings and companies are doing. And then the final column is really around carbon footprinting, and you've obviously got that amber rating for your passive equity, where obviously your passive equity, there isn't any active decision around carbon exposure, so you're actually getting the carbon exposure of the index. But we've looked at your active managers as well, and overall you're seeing managers who are more carbon efficient, so they've got lower carbon intensities than the benchmark. Overall, you can see there's a fair amount of green, from good to best practice, which is pleasing. There's a number of ambers and a small number of reds as well on the ESG ratings side of things. So I think those give you pointers to where you can improve things. I believe Patrick's already mentioned the Climate Aware Fund. And so obviously, as that hasn't actually been captured in the carbon footprinting to date, but as you capture that going forward, obviously you'd expect to see a better carbon footprint. The final slide that I was going to leave you with was page 221, which we've kind of zoomed in on the manager level, and Peter, as I said, can answer any specific questions in section 2. But if we zoom out a little bit, we've got 3 areas that I think it's worth the fund very much considering further. The first is what we call the TCFD framework, so the Task Force on Climate-Related Financial Disclosures. This is a framework that's split across 4 pillars and likely to become law for large occupational pension schemes. And I suspect it will also be a requirement for LGPS. But it looks at how schemes manage climate change in relation to governance, strategy, risk management, and then metrics and targets. So that is something that I think is going to become, it's a best practice framework. It's a very useful framework. It's something I think that will that should be considered. We've got the stewardship code. I've already talked about that. I think it will be a step up for your managers, and it won't just affect your listed equity managers, I've said already. But I think that the fund itself, if you look at the guidance for preparing an investment strategy statement, it's pretty clear that it expects LGPS to become signatories to the stewardship code. So I think that's where we're moving as well. And the final point that I would make, and I think the work that you've done to date, the progress that you've made to date, is something worth communicating and building on. So just reporting for members and other stakeholders is another area that I think should be a really key area of focus going forward. That was all that I was going to say in this section. I don't know if there are any initial comments or questions. I'll leave the chair to ask that.
Yeah, I'm cognizant of the time. Any questions? Although I've got one myself, but I'm holding back and giving others an opportunity. But clearly, I'll do mine first. Okay, this report and the work that we've been doing up to date is in relation to monitoring what our managers are doing in relation to the various topic areas that you've discussed. We haven't yet engaged with the opportunity to require them to do things. In other words, if we have a yearning to have a situation in which, for instance, we no longer wish to invest in tobacco companies, instructing our managers that that is what our policy is and that's what we want them to do. Similarly, although I note there is a little on page 11 of the report, an interesting comment by Bailey Gifford in relation to Mark Zuckerberg and Facebook, but we came across a situation in which the governance code, which I think requires or recommends that the chief executive and the chairman of a company should not be one and the same person. If we felt that was an important factor in our consideration of governance, and that's what we wanted our managers to vote on, where do we have the opportunity to make that requirement a consideration in terms of their actions that they take at a annual general meeting? So my concern here is we've got the monitoring process right. What we need to have is the ability to instruct our managers to do certain things, and I'm not sure we've got that yet.
Yes, I think you're correct. I think this monitoring piece has given you a baseline. It's given you an insight into what the current state of play is. And so I think if you wanted to adopt any new policies, I think this initial monitoring gives you a good understanding of where you'd need to move to. I guess if we were thinking about exclusions generally, yeah, you'd want to make sure that anything is consistent with your beliefs. You'd bring it into your policy, and then you'd need to make sure that it's actually able to be implemented practically within the pooling context. So I think part of the next steps might be understanding what other funds felt the position was, and then engaging with Access to see how and if whatever exclusions you felt were necessary could be implemented. On your voting query, Access does have a voting policy. And so my assumption would be that in theory, you could require all managers to vote in line with that policy. My understanding at the moment is that managers have the option to do that. So at the moment, you might have managers voting in different ways, some voting completely in line with the policy, others with the ability to override the policy, and others just following their own policy at the moment. So something to take up going forward.
Yes, I've discussed with this with Patrick, and I think it's an area perhaps that the working group might just spend some time discussing at a future meeting, which is the best way of approaching this situation and developing our position beyond the mere monitoring of what people are doing, and come to a conclusion as to how we can require them to do certain things. So I'm sure Patrick has got that on the list of things that we need to discuss. I just ask him to confirm.
Yes, I have got it on the list, Ralph.
Very good. Okay, anybody else who would like to ask a question? Otherwise, I think it's prudent that we move on, because we have only got another half an hour or so of my time available. So if we can confirm that the pension committee notes the comments and of the report. So everyone happy? Good. We'll therefore move on to part 2. Thank you for that presentation. Part 2, we'll advise. Hold on, let me just see what we've got on the agenda here. Okay, the part 2 papers are now required to be considered, and that means excluding the public. So I'm asking for the public publication of the meeting to be suspended, please.